welcome to Policy Watch. Before I introduce my guest this week, these are the headlines. The Prime Minister's Economic Advisory Council stays optimistic, says growth in FY13 will be 6.7%. Current account deficit seen at 3.6%. Taming inflation, diesel hike and capping the number of subsidized LPG should be top priority, says Rangarajan. In other news, headline inflation for July eases, but exports shrink for the same period. FII inflows looking good again. Policy Watch gets an economist to break it down for you. Judicial reforms back in the news. Accountability and transparency, says the Prime Minister. The country's top jurist cautions against tinkering with the Constitution. Those are the headlines, and it's my pleasure to introduce M.K. Venu, Managing Editor of the Financial Express, as my guest this week. It's his first time on this particular show. We hope he comes back for many, many more. Welcome to Policy Watch, Venu. We start straight off with the PMEAC meeting, the report. The Prime Minister's Economic Advisory Council came out with its report, and the projections for FY13, inflation and GDP growth are slightly more optimistic. Dr. Rangarajan, the chairman of this panel, addressed the media and outlined a diesel hike in 2 phases, capping the number of subsidies in LPG as top priorities to cut the deficit. The chairman said that the current account deficit would remain at 3.6% of the GDP for FY13, and that lower gold and oil imports would help improve the trade balance. This was on Friday morning, Venu, and you obviously must have seen the speech as well. Apart from a slight revision here and there, the feeling you get immediately after seeing that speech and that report is that the chairman hasn't really said anything new, except to reiterate what different spokespersons for the government have been saying for months now. Thoughts on that?
Well, it's true. Broadly, he hasn't said anything dramatically new. But what I find interesting here is that he's projecting a GDP growth of 6.7%. Which, to my mind, is not only optimistic. I'm not saying that I'm not a pessimist. I'm not saying that it's not achievable, but it is. He's trying to induce a sense of growth actually reviving over the next 3 quarters.
Right.
And I think the government is being very. What should I say? The government is being bold in projecting 6.7 because. If you see globally, if you see even other emerging economies, China, Brazil, they have come up about 4% of their peaks. You know, China is staring at sub 7% in the latest quarter.
Right.
So, and Brazil, which used to grow at 7% at peak, is now growing at some 3 or less than 3. Right. So, given that India, the last quarter reported quarter was 5.3 or 5.5.
Around that.
Yeah. To say that 6.7 is actually also saying that in the next in all the quarters this year they will get above 6%.
Immediately the reaction from the markets and the industry, I was watching the news like everybody else, it was that, oh, this is not something new, it's slightly more optimistic than we would like. No economist would agree that 6.7 is achievable, 5.1 and 2 is more realistic. Would you agree with that? The pessimism seems to be not from the government side this time around, but the pessimism seems to be coming from industry and markets reacting to this report.
Yeah, that's what I find that very interesting because all the equity research analysts coming from the Morgan Stanley, Merrill Lynch, all the global equity research people who are invested in the market, who are watching Indian economy very closely. Yeah. They used to be optimistic until about 2 years ago. And now they're talking about 5%. Some people are talking about sub 5%, which I think is highly it's very pessimistic. I don't think which is being almost predicting doomsday. Because if you have sub 5%, then you're sure to get a ratings downgrade.
Right, absolutely.
Yeah. So I find this may be slightly optimistic, but I find that the direction is now, in my view, is upward because we have hit the bottom. I don't think we'll go down below 5.3 or 5.5 that we got.
So you do believe that we've hit rock bottom? It can't get any worse?
I don't think it can get any worse. And there is also some data to show that that things are actually not getting worse. And
they're turning around, perhaps.
Yeah, there is some feeling that,
right,
that things are improving because consumer goods offtake, although down, it's not showing signs of collapse.
Right, right.
So the consumption-led growth is happening now. It's for the government now to actually drive that investment-led, revive investment optimism by, and Dr. Rangarajan has said several times, you might have heard him, that public sector, especially coal, Coal India Limited, railways, NTPC, if some of these people, NTPC does 70% of the power, capacity addition.
Right.
If they get their act together and move projects, investments in these areas where demand is clearly ahead of supply.
Right.
It's nobody's case that demand is,
Dr. Rangarajan, in fact, included in his speech a sector-wise breakdown of what the economy would look like. Let's give our taste, a viewers a taste, that is you, of the optimism that we are talking about, what Mr. Rangarajan, Dr. Rangarajan and the government seems to be emitting right now. He spoke about manufacturing sector, he spoke about services going to 8%. This is what he had to say. Take a look.
We project a growth rate of 6.7% in 2012-13. We expect the growth rate in agriculture to be 0.5%, in industry 5.3%, and in services 8.9%.
So he's saying services might hit 8% growth by the end of FY13. He's saying industry will grow at 5.3%. The two top priorities, Venu, that Rangarajan has outlined is the diesel hike in 2 phases. That is going to be very important, very crucial for the next 2-3 months while the government considers it. Early reactions to the report suggested that there might be something after the monsoon session. Do you agree with that? Do you think the government, because like you said, is being bold, they might just touch diesel this time around?
Yeah, Athar, I am now convinced that this government will definitely hike diesel prices. It will be done in 2 phases, he's right. And the government will simultaneously give commitment that in all drought affected areas, which the Prime Minister has already done, that farmers will get special transfers, maybe it could be in some direct cash transfer or some subsidies for distressed farmers, since this is a drought year, in areas. As diesel subsidy. So I think they'll have some plan to ring fence farmers. Otherwise, for all other urban users of diesel, motor cars and all, definitely there'll be a 2-shot hike. And mind you, this is one big change. I wouldn't call it reform because raising price is hardly reform. So these days everything is reform. So,
reform is a very catchy phrase
so,
these days.
So raising price. So this is one change that the markets are looking for. And even the rating agencies will be somewhat assuaged if diesel prices are raised, which also then would give the signal that the fiscal consolidation process and the oil, especially the oil economy subsidy, is being addressed. So if that signaling goes, I think it will be beneficial for the from an overall signaling.
Right. He also mentioned 2 more important things. Another reiteration, no doubt, that FDI in multi-brand retails 49% should pass, as well as FDI in aviation. Do you think these 2 are also important? Because if he is saying it just during Parliament when Parliament is in session, do you think that would also be an indication that perhaps multi-brand retail FDI perhaps might make a comeback after this session is over and the government might go ahead?
I think that it will come back because Arvind Sharma is already on record saying that that they will see this is the states which give licenses, as it were, for under the Shops and Establishment Act for actually physically launching multi-brand retail. So the centre has decided that it will announce a broad policy framework and leave it to the states. There are many states. I'm told that the government is going to announce in Parliament that at least 6-7 states have formally come forward and said that they want to implement multi-brand retail.
Right.
So I think by just getting 6-7 states. And if some of these states are, they constitute about half of India's consumer base, or I'm sure about 3/4 of India's consumer base.
Right.
So you implemented about 60 to 70% of multi-brand.
Fair point. One more thing, the worries, the concern that he outlined today, of course, one is taming inflation should be the highest priority. The other thing he mentioned, and that struck me, was that the investment and the savings rate are gone down, and that's his biggest concern. What is your outlook on the savings rate and the interest rate?
See, that is serious because from the peak in 2007, savings rate are down about 4%, a little more. I think we had about 36%.
I think it's around 30, hovering around 30, 31 right
31 now. So we had 36, 35 to 36, and now savings is a concern, and my sense is that as the economy picks up and incomes are generated and investment pickup happens, I think there will be an automatic kicker for savings also, because this increase in savings, if you remember, haven't happened during the boom period.
The boom period.
Pre 2003, our savings rate were at whatever. 30%.
We have the same finance minister, so you never know.
Yeah.
We have the
But
same-
more importantly, one of the most important things that come out of this, the numbers that Dr. Rangarajan has presented, is that so far the worry was twin deficits, fiscal deficit and current account deficit. But current account deficit is getting resolved by itself, because if you see the capital flow figures and the current account, we are back to, as per this projection, we are back to a balance of payment surplus.
Yeah, $72.2 billion for FY12.
And the deficit is about 67.
Right.
So there is a surplus this year, whereas the previous year there was a deficit. Current account deficit was higher than the capital net inflows. So this will actually have a salutary impact on the rupee, because the moment you anticipate that your capital flows will be higher than your deficit, you're adding that much to
So
the
much to look forward to in the next
So
financial
the
year.
exchange rate will also, I think, strengthen a bit. Could strengthen a bit if this pans out.
Right. More with MK Venu. We'll take a small break right now. On the other side, we'll discuss how exports shrunk in July, but headline inflation eased. Come back after the break. Welcome back to Policy Watch. We're still chatting with MK Venu, who's the managing editor of the Financial Express. Our second story this week now. It is a mixed bag for the Indian economy at the start of this week, as inflation, calculated by the Wholesale Price Index in July, fell to 6.87%. Its lowest level since January 2010. Inflation, as measured by WPI, was 7.25% in the previous month, while it was 9.36% on a year-on-year basis. But even as inflation eases, there was a dampener in store as well, as India's exports for July shrunk by 14.8%, the worst performance since November 2011. Rahul Kapoor with the details. Take a look. Aided by softening in prices of food and fuel articles, headline inflation declined to its lowest level since January 2010 at 6.87%. According to the data released by the government, food inflation eased to 10.06% against 10.81% in June. Fuel group inflation fell sharply to 5.98% from 10.27% in June, while manufactured products rose to 5.58% against 5.02% in June. Persistently high inflation has kept the RBI from lowering its interest rate, even though growth in Asia's third largest economy slowed to its lowest level in 9 years. A headline inflation rate of around 5% is seen as the Reserve Bank of India's comfort level, but it has stayed well above that for 2.5 years now. India's exports, on the other hand, took a beating, with the July numbers shrinking by 14.8%, the worst showing in almost 9 months. India managed to export goods worth $22.4 billion till July this year. Poor demand in traditional markets like the US and Europe have contributed to the stunted exports. Major segments took a dip in this period, with petroleum products slipping by 19.4% and engineering goods shrunk by 16%. The export target for the year is $360 billion, a stiff ask by any yardstick. And the government has admitted that achieving a 20% growth in exports by 2013-14 is not going to be easy, especially as the global economic conditions remains very uncertain. There is, however, a silver lining, as India's trade deficit has narrowed from $61 billion to $55.6 billion in the first 4 months of this financial year. With Rahul Kapoor, Athar Khan, RSTV. There you go. There you saw sort of a mixed bag then, Venu, for the Indian economy right now. Exports suffering, inflation easing slightly. Should we look at it glass half full or glass half empty?
See, as I said, from this point onwards, as I said earlier, we've hit the bottom. From here on, growth has to be higher than what we saw in the last reported quarter, 5.3 or 5.5%. I am certain it will be above 6%. Inflation is also stabilizing of a lower base, of course. Of a higher base, so it will stabilize. And manufacturing, in particular, in my view, will remain under 5%. The core inflation, manufacturing. It used to be 7%, about 8-9 months ago. So you're seeing that it has really moderated substantially the core inflation.
This moderation that we talk about, there was a guest
on
my
food
show.
inflation, there could be, on the contrary, food inflation, there could be slight upward pressure. But a more stable and moderate core inflation, which has 64% weightage in the basket, will keep overall headline inflation, I think, below 7%.
I mean, last week on the same show, I had Abhik Barua, who's the chief economist in HDFC, a banker, so to say. And I asked him whether he sees inflation becoming worse before it becomes better. And he said definitely, and he sees a big dip now. Now, July inflation is slightly eased. Would you agree with Mr. Barua's view when he says that inflation is going to worsen before it gets better? Or do you think should we take this sign as the starting off point of where we end up taming the inflation monster?
See, I don't entirely agree with Abhik Barua, but I partially agree with him. Food inflation will get worse before it gets better on a more sustained basis, because this drought situation and some supply issues could create, and the food and fuel category, if we adjust diesel prices upward, it will show up in higher inflation. So food, fuel together would be about 35% weightage. So in the overall basket. These two will get worse before getting better, but manufacturing core inflation, I think, will remain broadly at current levels, which is little under 5.
Right. The projection, of course, by Mr. Rangarajan was 6.5% by FY13. So around that period, around that.
No, 6.5 is his overall, I think.
His overall inflation.
Overall
inflation. Now, Venu, RBI has been saying that it won't touch interest rates till inflation eases to their comfort level as well. Now, even the PMESA report has said that taming inflation is critical. The report estimates 6.5, like we just said, it will set it around. Should we see this latest July inflation number? In that sense, do you think the RBI, in case this is a slight easing, this is not really something really substantial that we can start celebrating already. But do you see RBI perhaps having a relook on their inflation-centric policy the next time they meet?
See, Athar, I am convinced about one thing. RBI is aware that there is growth stagnation, there is investment pessimism. So RBI, in my view, the moment the government takes one or two actions on fiscal consolidation, like diesel price hike. The moment government does diesel price hike, RBI will complement it with a at least a minimum 25 basis point drop in interest rates.
Right.
That I'm convinced about. It's waiting for the government to take the first step, then it will complement. This is RBI's position that government should first do something and then we'll complement it.
Right. A fair point. Now, let's talk about exports for a bit now. We have some time to talk about exports. The target now, according to the government and the industry, of course, is 20% growth in exports. That is around 360 billion US dollars. We finished July at $22.4 billion. It looks like it's going to get worse for exporters. Even Rangarajan mentioned that global slowdown will hit Indian exports. Do you agree that exports, even as we are recovering, even as the economy is recovering, exports perhaps will have to suffer for a bit more?
It will have to suffer because I don't think this 20% growth target is a tall order.
Very, very, very stiff ask.
And because, I'll tell you why, because these targets were set when the policy was made some months ago.
Right.
Subsequent to that, things have worsened in both Eurozone and even US is showing no signs of really recovering in any substantive way. And OECD has come up with a report just 3-4 weeks ago saying that the OECD economies probably won't come back to the earlier unemployment levels until 2013 and even beyond, which seems it's a very pessimistic picture that is painted. So until OECD recovers, exports will. I don't think we should expect export to grow at 20%. That's a bit
We
of
should
a tall order.
expect exports to really take off, per se. If they manage to stay level, manage to keep their heads above water, they should be happy.
Yeah, they should be. I think what 7% growth, 7 to 10 should be more like it.
More realistic. We'll take another short break. Venu will come back and discuss our third story of the week. Don't go anywhere. More with MK Venu and yet another story after the break. Welcome back to Policy Watch. There is renewed interest from FIIs in the markets. The last few months have seen a flurry of activity. In the March to June period in 2012, FIIs increased their holdings in major companies from pharma, consumer products, IT companies, energy, automobiles, and also trimmed their holdings in sectors like banking, finance, and entertainment. Policy Watch spoke to the chief economist at the PhD Chamber of Commerce. Take a look.
There is some good news for the slowing economy as foreign investors seem to regain confidence in the Indian markets. And to talk more on this, I have with me Dr. S.P. Sharma, Chief Economist, PhD Chamber of Commerce. Welcome to Policy Watch, sir. Foreign institutional investors have pumped nearly 48,000 crore rupees in the markets in the month of August so far. What do you think are the reasons for this?
See, India is among the fastest moving economies of the world. Its growth rate is still high as compared with developing economies, as compared with emerging economies, as compared with advanced economies. Its investment rate, its saving rate is also high as compared with many economies of the world. And second thing, its export sector is also doing well. Its export growth was really wonderful during the last year, 2011, highest among the various economies of the world. And now, FII groups are again relying on India's growth story, that in the coming years or coming times, India can again attain the high growth trajectory. Due to some reasons, due to some policy reversal during the months of February and March, FIIs had withdrawn money from India, not only because of some policy issues, but also some re-emergence of European crisis in the European Union. But now, again, they are relying on India and investing in Indian market.
Is it also possible that with the government indicating a softer stance on issues like GAR and retrospective tax laws, many FIIs which had stayed out of Indian equities are coming back to India? And how far do you see this going?
I believe government should not rule out GAR at this juncture because economy faces many problems in the domestic front because of some policy issues like gridlock on some major policy issues like Land Acquisition Act and environmental issues. And its industry growth is really in the bad shape. It is in the sluggish trajectory, sometimes in the negative trajectory also. And now the FII is relying on some policy formulation for the compatible policy formulation for the Indian economy. But if government implements issues like GAR, then definitely there may be some withdrawal of money from the Indian markets. But at this juncture, they are relying again on India and investing in the Indian markets.
Mr. P. Chidambaram has recently taken charge of the Finance Ministry and he said that he'll announce steps to revive investor confidence. How far is his presence in the Finance Ministry responsible for this increased capital inflows?
I would say he's a man of reforms. Last time during 2003-04, he had implemented VAT. At this juncture, we are expecting big reforms from Mr. Chidambaram. We are expecting implementation of GST in the coming times, maybe in the next 1 year going forward.
Buoyed by strong capital inflows, markets have been on an upward trend recently. But what is the way to go up from here?
I believe these advanced economies will remain in the sluggish growth trajectory. These economies are in the high debt GDP ratios, high unemployment rates. And this is not for only quarters or months or years. The situation may linger for longer, maybe for decades. So global liquidity will flow from one country to another, searching for potential growth partners. And India is one of potential growth partners of the emerging economies. So I would say maybe there may be some volatility in the Indian economy, in the Indian markets, but again, they will rely on Indian markets going forward.
Thank you so much, sir, for talking to Policy Watch.
Rahul Kapoor there talking to the chief economist at PhD Chambers. That's all the time we have. But before we leave you, we must thank our guest, MK Venu, for joining us on the show this week. We hope you come back, like I said, many, many more times. Sure. Of course, before we sign off, the first story, the top story on Policy Watch this week was the Prime Minister's Economic Advisory Council. They're staying optimistic. They think that we can exactly hit that 6.7%. And since the current account deficit is still seen at 3.6%, Venu also agrees we've hit rock bottom, and the only way we can go now is up. Perhaps this is the time where we turn around our economy. The second story on Policy Watch this week was the fact that exports have shrunk. On the other hand, headline inflation has eased. My guest this week seems to think that perhaps this could be a sign that exports might have to suffer, but we are going in the right direction. Inflation can be tamed, but we'll have to wait and watch whether or not we can, in fact, overcome that particular problem. Those were the key takeaways. That's all the time we have on Policy Watch this week. Till next week, Athar Khan saying goodbye, good night, and thank you for watching.